You've probably heard the headlines. Prices are falling, inflation is cooling, and relief is finally here. But if that's true, why does your bank account still feel tight? Why does grocery shopping still hurt? Why do bills still feel heavier? Today, we're going to talk about the gap between what the numbers say and what real life feels like. Every year, millions of families wait for this moment, believing they're about to save money. But what if the biggest sales day of the year is actually costing people more than they realize? This isn't about shopping. It's about the psychology behind the choices we make, and how a single day quietly shapes our financial future. Prices are falling in America. That's what the headlines say. Inflation is cooling. Gas is cheaper in some places. Discounts are back. So here's the question nobody wants to answer honestly. If prices are falling, why does life still feel harder? Why does grocery shopping still hurt? Why does rent still feel heavy? Why does your bank account feel like it's not breathing? This video is not about panic, but it is about a warning. Because when prices fall and people still feel broke, something deeper is happening. And if you misunderstand this moment, you don't just lose money, you lose time, stability, and options. Today, we're going to break down what's really going on behind falling prices in the US. No hype, no comfort stories, just clarity. Open any news app right now and you'll see the same theme repeating. Inflation is easing. Prices are cooling. Relief is finally coming. On paper, it sounds like good news. After years of rising costs, people expect falling prices to feel like a release. Historically, that's how we're trained to think. High prices go up, life gets harder. Prices come down, life gets easier. But real life doesn't move in clean lines like headlines do. What's actually happening is more selective, more uneven, and more dangerous if misunderstood. Some prices are falling, but others are frozen in place. And some costs never come down once they go up. This creates a strange psychological moment. The economy says improvement, but households feel pressure. And when people feel pressure but hear good news, they blame themselves. They assume they're doing something wrong. That belief is powerful, and it's exactly where mistakes begin. Because falling prices don't automatically mean your financial reality improves. In some cases, they signal the opposite. Here's the part most headlines skip. Prices don't fall together, they fall in layers. Gas might drop. Electronics might get cheaper. Travel deals might show up again. But rent doesn't fall easily. Insurance rarely drops. Healthcare doesn't reverse. Education costs don't rewind. These are the expenses that define your month, not the optional ones. So even if some prices fall, your core financial pressure stays. And that creates confusion. People feel like relief should arrive, but it doesn't. That gap between expectation and reality creates frustration, and frustration leads to bad decisions. This is where the warning starts. Because when people believe things are getting better, but their reality disagrees, they start forcing optimism. They spend earlier. They relax discipline. They assume the hard part is over. And that's when they're most exposed. If this perspective helped you today, consider staying with the channel. We focus on clarity, so your financial decisions feel lighter, not heavier. In economics, falling prices are not automatically good news. Sometimes they mean efficiency. Sometimes they mean innovation. But very often, they mean demand is weakening. And that's the part people don't like to hear. When prices fall because consumers are strong, companies still grow. Jobs stay stable. Wages hold. But when prices fall because people are spending less, businesses don't celebrate. They prepare. They cut costs. They slow hiring. They delay expansion. And quietly, they start protecting themselves. This is where the macro signal appears. Falling prices combined with stagnant wages is not relief, it's compression. It means the economy is trying to adjust without openly admitting stress. Historically, this phase comes before job market softening. Not a crash, not panic, but erosion. the kind that doesn't make headlines until it's already done damage. Look closely at what's happening beneath the surface. Consumers are becoming selective. Credit usage is changing. Savings are thinning. This forces companies into a corner. They can't raise prices anymore, but their costs haven't fully dropped. So margins shrink. And when margins shrink, companies don't respond with kindness. They respond with efficiency. Efficiency sounds positive, but in reality, it often means fewer jobs, more automation, and higher performance pressure on workers. This is how economic pressure travels silently. Not through price tags, but through balance sheets. And once that shift begins, it rarely reverses quickly. Here's the dangerous misunderstanding. People hear prices are falling and assume the worst is over. Markets do something similar. They price in hope before results appear. This creates a timing trap. Optimism arrives early, stability arrives late. And in between, mistakes are made. Investors overextend. Consumers loosen discipline. Governments delay hard decisions. Everyone expects recovery to continue, just because decline has paused. But pauses are not recoveries. They are transitions. There's a word economists avoid using casually, deflation, not because it's mysterious, but because it's politically uncomfortable. Deflation doesn't mean cheap. It means people stop spending because they expect prices to fall further. When that mindset spreads, money freezes, businesses sell less. Hiring slows, wages stall, and debt becomes heavier because fixed payments don't fall even when prices do. That's why central banks fear this phase. Not inflation's peak, but what comes after the slowdown. The US economy is built on consumption. When spending slows, everything feels it. Retail, real estate, advertising, tech. Falling prices don't hurt evenly. They expose weak balance sheets first. Highly leveraged companies struggle. Overvalued assets get questioned. This is when narratives shift. From growth stories to survival strategies. And survival is not glamorous. It's quiet. It's cautious. And it rewards patience, not optimism. Smart money doesn't panic during falling prices. But it doesn't celebrate either. It watches three things closely: employment trends, credit stress, consumer confidence gaps. Because when prices fall but confidence doesn't return, something structural is wrong. And structure moves slowly, but when it breaks hard. This is not a prediction of collapse. It's a reminder of timing. Falling prices are not the finish line. They are the middle of the story. How you interpret this moment matters more than the moment itself. If you treat falling prices as permission to relax discipline, you risk being early, and early is expensive. If you treat it as a signal to stay observant, flexible, and patient, you protect options. And in uncertain economies, options are power. The loud voices will tell you everything is fine again. The smart move is not to argue with them, but to quietly prepare anyway. Because economic cycles don't reward noise. They reward those who understand the phase they're in before everyone else does. At the end of the day, this was never about sales, prices, or a single weekend. It's about awareness. Every smart financial future starts with one quiet habit: pausing before you act. Choosing intention over impulse. If this video helped you see things a little more clearly, take one small step today. Like this video so more people can find it. Share it with someone you care about, because one good conversation can change a family's future. And if you want more honest, simple breakdowns that help you make better money and saving decisions, subscribe to the channel. No hype, no shortcuts. Just clarity, so your future choices work for you, not against you.